So let me just have a quick recall, a quick discussion about the working capital management. And once I have actually gone about the major revision of the working capital management, so I would take you people through the examination questions on this working capital management. Now, first of all, if I talk about the concept of working capital, so you know this thing that in order to have a business, you need capital. There is capital that is needed for long-term investment, and there is capital that is needed for short-term investment. What exactly do you mean by the capital needed for long-term? What exactly do you mean by capital needed for short-term? So when we talk about the capital that is actually required for the long-term, so like you have got any capital nature expenditure, like you have to apply the non-current asset, etc. So you need the long-term capital. But what is the short-term? So basically your day-to-day operations, your day-to-day routine matters. If you need money for that specific purpose, that is going to be considered as your working capital, that is going to be considered as your short-term finance. So let me repeat, when we talk about a working capital, when we talk about the short-term finance, so what does it actually mean? It's actually your day-to-day, your routine matters. That is what is the working capital is required for. So now, if I talk about the definition of the working capital, so let me just have a quick recall that what is the working capital actually described as. So the working capital is actually defined as current assets less current liabilities. Working capital is actually defined as current asset less current liability. Now, when we talk about the current assets, what exactly are the current assets going to be? So you have got the trade receivables, you have got the inventory, you have got the cash. This is all going to be considered as your current asset. I repeat, this is all going to be considered as your current asset. Similarly, when we talk about the current liabilities, so basically the current liabilities are going to be your payables, the current liabilities are going to be your overdraft, things like that. So that is going to be considered as a current liability. So whatever the net amount as a business you have, that is going to be considered as working capital. So let's assume that you as a business have an asset, which is the current asset of 100,000, and you have a current liability of, let's say, 30,000. So resultingly, we would say that 70,000 is invested in the working capital. So I repeat, resultingly, what are we going to say? We're going to say that 70,000 is invested in the working capital. Now, if I move a bit forward and if I talk about this working capital management, so let me just guide you a bit about the working capital management. Basically, whenever we talk about the working capital management, so you need to understand that there are certain objectives of working capital management. And those objective is to actually strike a balance between profitability and liquidity. Whenever we talk about the working capital management, so there is actually the core objective of working capital management is that we have to strike a balance between profitability and liquidity. What do you mean by profitability? So like, for example, if a business has got a very high amount of sales, but if all the sales are on credit, so the sales would actually lead to the increase in profitability. But at the same time, these credit sales would make sure that your liquidity is deteriorated. Your liquidity is deteriorated. So as an entity, what is it that you have to do? So let me just guide you a bit. As an entity, what you have to do is that you have to strike a balance between profitability and the liquidity, which is you have to decide that to what extent should we actually focus upon the profitability, to what extent should we focus upon the liquidity. That is something that you as an entity have to decide. Now, let's move a bit forward and let's discuss a bit further. So basically, you cannot just focus on profitability and compromise liquidity. At the same time, you cannot just focus on liquidity and compromise the profitability. So basically, we need to strike a balance. Now, so in order to discuss the working capital management, we would talk about each one of the items one by one. The first thing that we are going to talk about is called the inventory management. I bet the first thing that we're going to talk about that is called the inventory management. Now, if I talk about the inventory management, so I would say that when we talk about the inventory management, so inventory usually has got a cost. The cost of inventory is majorly made up of three things. What are these three things that the cost of inventory is made up of? One of them is called purchase price. The other one of them is called holding cost. The third one of them is called ordering cost. So I repeat, when we talk about the inventory management, the cost of the inventory is actually made up of three things. What are those three things which the cost of inventory is made up of? The cost of inventory is made up of purchase price. It's made up of holding cost. It's made up of an ordering cost. Now, if I talk about the inventory management and if I talk about the cost of inventory, obviously every organization would want to minimize its inventory cost. Every organization would want to minimize its inventory cost. Now, the purchase price is actually the price at which you buy the inventory. But when we talk about the holding cost, there are multiple costs. Like, for example, you have got the warehouse rent, you have got insurance, you have got inventory obsolescence cost, you have got security cost, you have got the theft cost, you have got the opportunity cost of fund. So there are multiple types of costs that actually are incurred when it comes to the inventory holding. So whenever we talk about the inventory holding cost, there are multiple costs that you as an entity incur because you're holding the inventory. Similarly, there is something which is called ordering cost. And when I talk about the ordering cost, so ordering cost would include a lot of things. It would include the delivery cost. It include the inventory handling cost. It would include the PO issuance cost. It would include the demand draft or the pay order cost, etc., etc. There are multiple types of cost, LC opening cost, documentation cost. There are different type of costs that you have to incur. So generally speaking, what happens is that what we try to do, we try to make sure that in order to manage the inventory, we usually adopt an economic order quantity model, which is also called EOQ. The formula for the EOQ is given in the examination, but let me just have a quick recall of what exactly is this EOQ all about. So when we talk about the EOQ actually has got components. CO is cost of placing an order. The D is the annual demand. CH is cost of holding. One unit per annum. CH is cost of holding 1 unit per annum. So basically, when we talk about the economic order quantity model, the economic order quantity model has got these things. CO is cost of placing an order. D is the annual demand. CH is the cost of holding 1 unit per annum. Now, let's have a bit of a discussion about all this. So every organization would want to achieve the optimal ordering level. And in order to achieve the optimal ordering level, what you need to do is that you need to follow the order quantity using the economic order quantity model. I'll give you an example, and through that example, I'm actually going to guide you that how do you calculate the economic order quantity and how do you actually go about with the things. Assume that you've got purchase price of inventory is 10 per unit. Holding cost is, let's say, $0.8 per unit. The ordering cost is, let's say, $1.50 per unit. And you've got an annual demand. And the annual demand is, let's say, 25,000. So if you've got this specific scenario, How exactly are you gonna do all the calculations and everything with respect to the economic order quantity? Let's try to understand. Basically, what is gonna happen is that the first thing that you're gonna do is that you're gonna say that if I have to apply this economic order quantity approach, if I have to apply this economic order quantity approach, so the first thing that I need to do is that I need to calculate the EOQ. What do I need to calculate? I need to calculate the EOQ. Now, if I have to calculate the EOQ, so how exactly am I going to calculate the EOQ? Let's try to understand this thing. Let's try to see this thing. Okay, so what are you gonna do? Okay, thank you, Muhammad Khan. Okay, so what are you gonna do? You're gonna say that EOQ, the economic order quantity, is 2 into CO. CO is cost of placing an order, which is 150 multiplied by annual demand, which is 25,000, divided by CH, which is 0.80. And you do an under root to all this. Okay, what I am actually getting is, I am getting it 3061. I'm getting it to be 3061.8, or I could just round it off to 3062. So what I'm actually getting is 3062. Can you just reconfirm? Can somebody of you reconfirm? Yeah, can anyone just reconfirm, please? Because to me, it turns out to be, it turns out to be what? It turns out to be 3061, 3062 approximately. Okay, now what next is there? So basically, this is the economic order quantity. Now, what the next thing is that when you are gonna do this all inventory cost, so there are two important things, and that is, one of them is called total holding cost. There is actually a formula for the calculation of total holding cost. And what is that formula for the total holding cost? It's actually like this. The formula is buffer stock plus order size divided by 2. And then you multiply it with CH. So like in this specific scenario, there was a buffer stock of 0. The order size was the economic order quantity, so it was 3062. divided by 2, and then you're going to multiply it with the cost of holding 1 unit per annum. So this is actually going to turn out to be what? So if you're going to say this, it would be 3062 divided by 2 multiplied by 0.8. So it's actually going to be 1225, 1225. That's going to be the total holding cost. Now, similarly, if I talk about the total ordering cost, I repeat, if I talk about the total ordering cost, what exactly is the total ordering cost going to be? So when you talk about the total ordering cost, you need to understand the total ordering cost is going to be the number of orders multiplied by cost of placing an order. So basically what is going to happen is that you're going to say that the annual demand is 25,000, 3062 is the order size. So that means the number of orders are going to be 25,000 divided by 306. Multiply by what do we have? The ordering cost as 150. The ordering cost is 150. So hence resultingly, what are you going to do? You're going to say 25,000 divided by 3062, and you have to multiply it by 150. Again, you would get 1225. What do you get? 1225. So what are you gonna get? You're gonna get 1225. Now, let me just guide you people a bit. Always remember that at the EOQ level, if your order size is the economic order quantity, the total holding cost equals total ordering cost if there is no buffer stock. I repeat, if there is no buffer stock, your total holding cost is gonna equal the total ordering cost. You get my point? Your total holding cost is going to be equal to the total holding cost is going to equal the total ordering cost when there is basically no buffer stock. But in case if there is a buffer stock, it's actually going to be a bit different. Right? Okay. Now, with respect to inventory management, there is one more concept that you should know. And that is basically at times from the examination perspective, the examiner would give you a scenario. The examiner would give you a scenario where he would say that the supplier has offered, let's say, X% discount. If order size is, let's say, 10,000 units, let's say. So what actually happens is that in case if the examiner gives you such a scenario where you have to make sure that you place an order and that order is going to be a bit different because the supplier has offered you a certain percentage of it. So what you should do is that you should compare the total inventory cost under existing order size versus total inventory cost under proposed order size. So like for example, if I can just give you a bit of an idea, let's try to understand something. Like you've got the purchase price, you've got the total holding cost, you've got the total ordering cost, you add up all of them. And then you compare them with the revised purchase price under the different order quantity, the different ordering costs under the different order quantity, and then you compare them and you see if it is beneficial for the company, then you should go ahead with it. If it is not beneficial for the company, then you should not go ahead with it. This is something that you would actually have to do. Right? You get my point? Okay. So from the examination perspective, this is something that you should know with respect to the inventory management. Now, one important thing is that from the perspective of inventory management, one ratio is important, and that is the inventory holding period. So inventory holding period is determined as inventory divided by COGS, and it could be multiplied by 365, could be multiplied by 12, it could be multiplied by 52, depending upon how the examiner wishes to calculate this period. So if he wishes to calculate in terms of months, if he wishes to calculate in terms of days, if he wishes to calculate in terms of weeks, whatsoever the thing is, you would have to calculate, you would have to do the calculation according. Now, what does this inventory holding period tells us? The inventory holding period actually tells us the time taken to sell inventory from the date of purchase. So whatever the time that is taken in order to sell the inventory from the date of purchase, that is going to be considered as your inventory holding period. What is it going to be considered as? Inventory holding period. So we have actually talked about the inventory management, that what are the areas of inventory management. I'm going to start discussing the other aspect of this working capital management, and that is about receivables management. Now, when we talk about the receivables management, there are a few important things that you should understand with respect to receivables management. One of them is called the receivable holding period. Sorry, one of them is called receivable collection period. Now, what exactly is the receivable collection period? Let's discuss about it. When we talk about the receivable collection period, the formula for this is the trade receivables divided by credit sale multiplied by 365 or multiplied by 12 or multiplied by 52, depending upon you wish to calculate in terms of number of days, or you wish to calculate in terms of years, or you want to calculate in terms of months or weeks or whatsoever that is. Now, in a lot of situations, what happens is that you're not being provided the credit sale, but instead only sales is given. So then you have to assume that the whole sale is credit. So you will have to assume that whole sale is credit. If so, in case if the sale is not distinguished, you have to assume that the whole sale is on credit sale. Now, let's try to discuss this thing, that what exactly does the inventory holding period tells you. So when I talk about, sorry, the receivable collection period, the receivable collection period actually tells you time taken to collect amounts from the customer from the date of sale. So the date when you make a sale, since that day till the time of collection, the time it takes, that is going to be considered as your receivable collection period. What is it going to be considered as? It's going to be considered as your receivable collection period. Now, obviously, the shorter the receivable collection period is going to be, the better it is for the entity. Now, why is it going to be better for the entity? Because you see, when you give credit to your customers, so your customers don't pay any interest rate. So the quicker that you are going to collect from them, the better it is going to be. I mean, the quicker that you're going to collect from them, the better it is going to be. Now, from the perspective of the examination, there are different type of scenarios that are usually examined. One of them is like, in order to manage the customers, there is at times credit extension. Now, what exactly do you mean by credit extension? That your existing policy was that you used to give a 40-day credit. And now what are you moving towards? You're now moving towards 60 days credit. So basically, how would you justify such a policy? How would you say that such a policy is good for the entity or it is bad for the entity? So there are a few things that you would actually have to do and you would have to see. Now, what are those things that you would have to do and you would have to see? So first of all, try to understand this. You would say the increase in contribution, because obviously when you give more credit, there's an increase in the contribution. If you give more credit, there's an increase in the contribution. And you would compare it with the increase in finance cost. Now, what exactly do you mean by increase in finance cost? Try to understand something. So when I talk about the increase in contribution and when I talk about the increase in finance cost, the increase in finance cost is going to be like this. You would say revised receivable, existing receivable, increase in receivable, OD cost is gonna be X percentage. So hence resultingly, what would happen is that you would compare it with this. And you would say net loss or net savings. So like for example, you would say that how much increase in the contribution is coming up. And with this increase in contribution, what is actually gonna happen? This increase in contribution, what is actually gonna happen? So like for example, if you were, because you see ultimately a receivable balance has to be impacted. Okay, let's move a bit forward and let's discuss further. So basically what happens is that you have to compare the increase in contribution and the increase in finance. Now, what are the other methods of actually dealing with this receivable management? So because you see every organization, what it does is that it tries to make sure that the receivable balance reduces to the maximum possible extent. So what next are you gonna do? Let's try to see this. The next situation that is actually going to happen is that you've got at times a policy of offering the early settlement discount. I bet at times what actually happens is that you offer the early settlement discount also. Now let's talk about the early settlement discount. So how exactly are the things going to be with respect to early settlement discount? Let me just try and explain to you people. What actually happens with respect to early settlement discount is that maybe you could actually tell your customers that your existing receivable period is 30 days. And if you are gonna make payment within 10 days, then we are gonna allow you 1.5% discount. So what are you simply gonna do? You're simply gonna do it like this. You would say, okay, let's try to see that what is going to happen. So you would say, interest cost saved. How would we know the interest cost saved? So we would say existing receivable revised receivable reduction in receivable interest rate. So this is actually going to be the interest cost saved. And you're gonna compare it with the cost of discount. How would you actually compare it with the cost of discount? You would actually get what? You would actually get the sales multiplied by percentage availing discount multiplied by discount percentage. So hence resultingly what would happen is that you would either end up saving the money or you would either end up losing the money. I repeat, you would either end up saving the money or you would end up losing the money. So hence resultingly what happens is that this is how you're gonna say. So maybe let's say that your existing receivable were 100,000, sorry, 1 million. Your revised receivable are going to be 700,000. So there is a 300,000 reduction in receivable. If there is a 10% rate, that means 30,000 is being saved in interest. And if the cost of providing the discount is 25,000, that means as a business, you would end up saving 5,000. I repeat, that means as a business, you would end up saving 5,000. What are you gonna end up saving? You're gonna end up saving 5,000. Now, there is this third aspect with respect to the receivable management, and that is about the concept of factoring. If I could have a quick recall of what the factoring concept is all about, so you would recall this thing that basically the factoring is what? Factoring is an arrangement where the receivable administration, ownership transferred to a factor organization. So the major benefit that the organization has is that the benefit to entity is factor gives advance. The second thing is that factor helps recovery. So there are multiple benefits that you get as an organization when you have got a factoring arrangement. Now, what are the different types of factoring arrangement? Let me just guide you a bit about that. When we talk about the different type of factoring arrangements, so the different type of factoring arrangements are these. They're called with recourse factoring. They are called without recourse factoring. What is a with recourse factoring? What's a without recourse factoring? So when you talk about the with recourse factoring, so it's a bad debt risk is not transferred. Here you would say bad debt risk transferred. So when you talk about the without recourse factoring, you would say the bad debt risk have been transferred. Now let me just guide you people a bit. Let me just take you people through that what happens with the with factoring and the without recourse factoring. So all that you need to do is that you need to understand that you need to compare the factoring offer. So how would you analyze a factor offer? That is something that you need to know. So in order to analyze the factor offer, you would have to see these things. You'd have to say administration cost saved, bad debt saved, interest cost saved, existing receivable multiplied by interest rate, revised receivable multiplied by interest rate. So there is going to be the interest cost saved, and there is going to be the factor fee. So what would happen is that you would have the net amount, which is the you would have got the net cost or net savings. What will you have? You will have the net cost or you will have the net savings. So basically, when you get a factoring scenario, what is it that you have to do? You have to analyze the factor offer. You have to see what's going on. You have to see how things are going to move. So you have to actually analyze the factor offer according. So this is all about the receivable management, and you would have to actually see if you would end up saving the money or not by introducing incentives and things for the customers. So you would actually have to see if you as an entity are going to save the money or not. That is something that you would have to do. Right? So with respect to the receivable management, these were the different type of things that could actually happen. The next aspect that we need to talk about, and that is basically called the cash management. If I talk about the cash management, basically what happens with respect to the cash management is that you need to know, you need to understand this thing, that if you have got a high balance, there is an opportunity cost of the cash. Why? Because you could have actually earned interest on that cash. When you've got a high balance, there could have been an interest cost on the cash. But similarly, if you have got a low balance, like if you would have invested your cash in some securities, this might actually lead to, I repeat, if you would have invested this money into some securities, this might have actually lead to the liquidity issues. So it's important from the perspective of the cash management that you should strike a certain balance, that what should be the cash balance, what should not be the cash balance. There are multiple actions that the organizations take in order to manage the cash. Now, one of the most important aspect is that in order to manage the cash, what you should try to do is that you should try to establish a cash flow forecast. What you should try to do is that you should try to establish the cash flow forecast. Now, what exactly do you mean by the cash flow forecast? Let me just guide you a bit. So when I talk about the cash flow forecast actually tells you that what is going to be the cash position in the future. Generally, what happens is that in order to make the cash flow forecast, you might do it on a monthly basis, you might do it on a quarterly basis, you might do it on a half yearly basis, whatsoever that is. There are multiple ways that you can have your cash flow forecast. So like you would plan out the inflows, you'll plan out the outflows. So if I talk about the inflows from the cash sale, the inflows from the credit customers, inflows from the cash sales, inflows from the credit customers, inflows from the loans, inflows from the grants, etc., the advances, then there could be outflows, loan repayment, expenses, capital expenditure, interest, taxes, etc. So what could possibly happen is that you could just create your cash flow forecast. When we create a cash flow forecast, so what actually happens with the cash flow forecast is that we plan out that what are going to be the cash inflows, what are going to be the cash outflows that we will have as an entity. So you'll have the net cash inflows and the net cash outflows. You will add up the net opening cash in it. And you would have the closing cash balance. I repeat, you would have the closing cash balance. Now, so basically what have I done? I've actually guided you about this thing that that what happens is that what we try to do is we try to establish the cash flow forecast. Now, when we try to establish the cash flow forecast, so generally what happens is that you would have an idea that you would have an idea that where exactly is it all heading towards. I repeat, you would have an idea that where exactly is it all heading towards. Now let's move a bit forward. Let's try to discuss further. So there are different types of cash management models. And amongst the different type of cash management models, one of the models that we have is Baumol model. The Baumol model is actually derived from the Baumol model is actually derived from the economic order quantity model. I repeat, the Baumol model is actually derived from the economic order quantity model. Now, what actually happens with respect to the Baumol model? Let me just guide you. Let me just take you people through with respect to this Baumol model. So under the Baumol model, we again follow the same formula, which is 2COD divided by CH. And then there is this under root. Now, over here under the Baumol model, what actually happens is that D is the annual demand for cash. D is the annual demand for cash. CO is the admin cost of selling securities. It's the admin cost of selling the securities. And then when we talk about the CH, so what actually happens is that cost of obtaining the funds. So like this CH, you need to understand, if let's say you could deposit the money at 8% and you could borrow at 10%, so CH is gonna be net 2%. CH is gonna be net 2%. So when we talk about the Baumol model, the Baumol model actually tells you what? The Baumol model actually tells you that how an entity could actually could decide that how much amount of the cash that it should actually generate or that it could actually transfer from it different investments at any point of time. So how much amount of cash that you should try to transfer, that's what the Baumol model is going to tell you. So all that you have to do is that you have to apply the Baumol model and you'll get an idea that how much amount of cash to be raised. Now, there's this another model which is called Miller-Orr model. If I talk about the Miller-Orr model, I'm just going to create a diagram and I'm going to guide you people through this specific diagram that what does Miller-Orr model tells us. Okay, basically under the Miller-Orr model, there are three things, which is upper limit, return point, lower limit. Now, for example, as a business, you are using cash. The moment your cash reaches the upper limit, you buy the securities to make it reach the return point. And then you are operating. At times, what happens is that when it reaches the lower limit, you sell some securities and you reach the return point again. Then it goes on and on and on and on and on and on and on. Let's say it reaches the return point again. Now, so what actually happens is that this is one action, this is another action, this is another action, this is another action. Now, what actually happens is that the cash balance keeps on fluctuating. When cash reaches upper limit, securities are bought such that cash reaches return point. When cash reaches lower limit, securities are sold such that cash reaches return point. So basically what happens is that there are formulas relating to this Miller-Orr model which are given in the examination. And let me just guide you this thing. The difference between upper limit and the lower limit is called spread. The return point is 1/3 multiplied by spread. The upper limit is lower limit plus spread. So there are a few important formulas that you should know. which is return point is 1/3 into spread plus lower limit. The spread is also calculated using this formula. This is given in the examination. So you have the spread formula available in the exam. Spread is actually the difference between upper and lower limit. So these are the things that are actually given in the exam. And you need to understand this thing. The Miller model actually tells you that this return point is the normal cash level that an entity tries to make. If the cash goes above the upper limit, you buy the securities and bring it back to return point. If the cash goes below the lower limit, you buy back the securities and bring it back to the return point. That's how things actually go about. So this is also about the Miller or model. Let's move a bit forward and let's talk about the payable management. One of the important aspects of the payable management is that the more the credit that you get, the better it is going to be. I bet the more the credit that you get, the better it is going to be for the entity. Now, when we talk about the payable management, so there is one important ratio which is called payable payment period. What is it? And when we talk about the payable payment period, it is called trade payable divided by either credit purchase, or if credit purchase is not given, multiply by COGS, multiply 365 or 12 or 52, depending upon what exactly are you trying to calculate. If you're trying to calculate in terms of days, if you're trying to calculate in terms of months, if you're trying to calculate in terms of weeks, etc., etc., etc. So what is it considered to be? It is considered to be the payable payment period. Now, obviously, as an entity, you would try to extend the period to whatever maximum possible extent. Now, one important thing that we need to do is that we need to actually, with respect to the payable, we need to evaluate if the supplier discounts should be availed or not. I mean, we need to evaluate if the supplier discounts should be availed or not. Now, how exactly are we going to evaluate if the supplier discounts are going to be availed or not? So again, what actually happens is that the discount received compared with increase in interest cost. How would you actually have an increase in interest cost? You would say revised payable. And then there is going to be existing payable. You would see reduction. And then you would say interest rate. So hence resultingly what happens is that either you will end up saving the money or you would end up losing the money. So you have to compare whether the supplier discount should be availed or not. Now I would go about discussing few more things with respect to the working capital management. And since I've discussed the payable payment period now, I need to discuss few more important things with respect to working capital management. One of them is called the concept of working capital cycle. There is another name for the working capital cycle and it is called cash operating cycle. How do we calculate this working capital or cash operating cycle? We calculate it like this. We say inventory days plus receivable days minus payable days. We would say inventory days plus receivable days minus payable days. Now, obviously, let's say if you have got a receivable days of 20 days, sorry, inventory days of 20 days, receivable days of 30 days, and if you've got a payable days of 15 days, so resultingly you would have 35 days as the cash operating cycle. What are you gonna get? You're gonna get cash operating cycle of 35 days. What does this cash operating cycle tells you? This cash operating cycle tells you that it takes 35 days for you to recover the money that you have invested in working capital. I bet it takes 35 days for you to recover the money that you have invested in the working capital. Okay. Now there is this one more aspect with respect to working capital management, and that basically aspect is working capital financing policy. That what are the different types of working capital financing policies that an organization would adopt. Now, let me just guide you a bit. Let me just take you a bit through all this. Now, if I say that when we talk about the working capital, when we talk about the working capital financing policies or the strategies. So for this, first of all, you would have to understand one thing, basically, which is called the current assets to be permanent current assets, and fluctuating current assets. Now, what exactly is the difference between the permanent and the fluctuating current asset? So this is usually stays fixed. It keeps changing. Now, let me just give you an idea that what exactly is this all about. See, for example, as an entity, at times you might actually have a buffer stock. I'll assume that this is your warehouse and this is the warehouse inventory levels. I'm saying that this is a buffer stock. Let's say this is a buffer stock. This is buffer stock. Now, what actually happens is that your inventory keeps on fluctuating, so on and so forth. Now, what actually happens is that this portion is going to be termed as permanent current asset, and this portion is going to be considered as fluctuating current assets. So I repeat, one of the portions is gonna be considered as permanent current asset. One of the portion is gonna be the fluctuating current asset. Okay. Now, what actually happens is that because I need to tell you about the different type of working capital financing policies. So I need to use these terminologies, which is the fluctuating permanent current asset. So there are three different types of approaches that you adopt. One of them is called conservative policy. The other one of them is called moderate policy. And the third one of them is called aggressive policy. Now, what exactly is the difference between all these three? Let's discuss. When we talk about the conservative policy, you finance both your permanent plus fluctuating. You finance both your permanent plus fluctuating current assets using long-term capital. When we talk about the moderate policy, the permanent current assets are funded by long term, the fluctuating are financed by short term. This is also called the matching policy. And when you have got aggressive, so your permanent plus fluctuating, both are funded by short term. So an organization could have all three different types of policy depending upon the risk appetite that it has, depending upon the risk appetite that is asked. Right. Is everyone okay with this? Okay, so that marks the conclusion of the working capital management revision.